Welcome back. The next 2 weeks are going to be critical on third quarter earnings. Take a look at where the markets ended this week after a slew of earnings reports, and things really pick up next week with a whole host of technology reporting their quarterly numbers, as a new Monmouth University poll shows inflation is still the most important issue for voters ahead of the midterm elections. Economists are now forecasting a 100% chance of recession next year. Joining me right now, a Queen's College Cambridge president, Mohammad El-Erian. Mohammad, you are among those who are expecting a pretty sharp slowdown, a recession next year. Can you assess where we are for the macro story and what you're expecting next year?
Yes, Miriam, we are in a situation where interest rates are continuing to go up into a slowing domestic and global economy. Why? Because inflation has been high and persistent. Why? Because the Federal Reserve has been late. So we are in this awful situation that we have seen historically, where the Fed ends up by tipping us into recession. There's one interesting aspect here, which is financial stability is also being threatened.
Yes, it's a great point, because that's what happened in the UK, and I want to get your take on the Bank of England's response to financial instability. But let's stay domestic for a moment, because I'm trying to understand how bad things will get and what you're expecting and what you're telling clients and advising in terms of protecting oneself or protecting your company in the face of what could be a severe recession.
Well, the most important thing is resilience. This is a difficult period, because whether you're a company or you're a household or you're investors, you've got both growth and inflation as your headwinds. So you need resilience. Now, different entities do it differently. In the case of a company, it's all about balance sheet strength. It's all about having cash on the balance sheet. In case of an investor, it is the ability to navigate this very bumpy journey. The hardest thing is households, because they are being pressured by high prices, by the cost of living, but also by increasing insecurity about their future income.
Great analysis. Meanwhile, it has been a bumpy road in terms of currencies. The Japanese yen at the lowest level since 1990. The dollar's strength has already been cutting into profits for some companies. What's going on in Japan?
So Japan is on the receiving end of the increase in yields globally. And that is really led by the U.S. The U.S. has three factors driving the dollar stronger across almost the whole world. The first is this is the most front-loaded interest rate cycle we have seen for decades. Why? Because the Fed is late, and they're scrambling to play catch-up. So there's an interest rate differential favoring the U.S. There's a growth differential favoring the U.S. Yes, we may be slowing, but we're much better than elsewhere. And of course, we are the safe haven. The problem with Japan, and that's what makes it interesting for us in the US and elsewhere, is they're trying to cap, they're trying to suppress interest rates, something called yield curve control. And that is proving very difficult. So they've sacrificed their currency, they're having to intervene in their bond market, they're having to intervene in the currency market, and there's starting to be concern that something is going to break in the Japanese markets.
And do you think it will?
I think we're going to get very close. Now, why should we care? It's because they own a lot of our security. They own treasuries, they own corporate bonds, they own high-yield bonds. So the last thing we want is the phenomenon we saw in the UK, you mentioned the UK earlier, of people being forced to sell and therefore ending up in this vortex where you're forced to sell, the price goes down, so it makes you sell even more. So that's what we really need to avoid.
Wow, that is a great point, Mohammad. In terms of the UK, Liz Truss resigning this week as British Prime Minister amid this economic turmoil, sky-high inflation. President Biden said he's not worried about the UK's political upheaval hitting the U.S. economy, but we know that what you just mentioned, the financial instability, sparked the Bank of England to change its stance. And I wonder if you expect something like that in the U.S. Does the Fed see the market selling off as a reason to pull back? But before that, give us your sense of what went on this week in the U.K. and the impact of Liz Truss's resignation.
So generally, Maria, we've gone from a world where economics used to influence politics to where politics tried to defy economics. And very large unfunded tax cuts was simply too much, a step too fast, too far, to quote Prime Minister Liz Truss. So what happened? The bond vigilantes came back and forced the government to do massive U-turns and force the Bank of England to intervene. For now, there is relative stability in the UK financial markets because the government has done all these U-turns. However, it's only a matter of time till the markets ask what next. But what the big lesson from the UK for other markets is that the bond vigilantes are back, and therefore the room for maneuver and the room for irresponsible fiscal policies is very, very limited.
Yeah, it's a great point. Do you think that the Fed could actually have a pivot the way the Bank of England did if they see markets get undone?
So first of all, we don't want that, because that's going to be like driving the car with a foot on the brakes and a foot on the accelerator. You don't really want to do that. We need a foot on the brakes for the Fed because inflation is so high, and we don't want inflationary expectations to get away from us, and they are already late. They've fallen into a mischaracterization of inflation that made them fall behind, and now they're scrambling to catch up. So the last thing we want is, on top of inflation, that they then have to intervene for market functioning reason. But there is a risk. I keep on repeating, it is not just that interest rates are going higher for longer, it's the faster. They are getting there really fast, very front-loaded, and when you change interest rate regimes so quickly, the system doesn't have time to adjust. And that's the risk we face on the financial stability side.
Well, there are so many risks, a dangerous moment for sure. Mohammed, it's good to catch up with you and get your insights on all of that. Thank you, sir.
Thank you, Maria.